Okay. Now, this topic is advanced financing decision. So this topic is advanced financing decision. In the old syllabus, it used to be referred to as capital structure decision, but the scope of that was narrow, and therefore the topic is advanced financing. Financing is broader. There are other aspects of financing which are captured. Now, when you look at this topic, the key areas of focus, the first two, I shared a document for you. You can see up there, when I say capital structure of the firm, of course, that is a brief introductory bit of capital structure, cost of capital, the relevance of the cost of capital, the component cost of capital, the firm's overall cost of capital, that is weighted average cost of capital, and the weighted marginal cost of capital computation. Now, those aspects are background that were laid in the lower level. I shared you with the notes, and I also gave you a video. So I'm going to pick on part 3. Today, that is what I want to talk about. Analysis of breakpoints in the weighted marginal cost of capital schedule. After we are done with that, we shall go through capital structure theories. That is the traditional theories of capital structure, the net income and net operating income theory of capital structure, Mordigilian and Miller's proposition, perhaps a very, very important part of this topic, argument by Franco Mordigilian and Merton Miller. Mordigilian, Franco Mordigilian and Merton Miller. I'm aware that you met Mordigilian and Miller in section 3 again, when you guys were going through dividends. That aspect has been tested again here 2 times. Though not in the syllabus, but again, Franco Mordigilian and Miller in relation to dividends has been tested twice. I'm a bit confused whether to talk about that concept here, because it's not in the syllabus, but has been tested. Mordigilian in the context of dividends. So this is Franco Mordigilian and Merton Miller in the context of capital structure. Then we have also other theories of capital structure, like the pecking order theory and the trade-off theory. Then leverage and risk. Now, leverage and risk, there's nothing new, ladies and gentlemen, I'll tell you. It's basically what you went through in the lower level again, section 3, computation of operating leverage, financial leverage, and combined leverage, and making interpretations. Analysis of operating profit, earning per share at point of a difference in the firm's earnings. Point of a difference in the firm's earnings. In the firm's earnings. This argument, if you remember, we went through it when I went through mergers and acquisitions. This issue of indifference appeared in the topic of mergers and acquisition, so there's nothing different. It's the same concept applicable in capital structure. Raising money, using various financing options to be able to finance an activity. Option 1, option 2. But whatever argument we did in mergers and acquisition applies in capital structure. So number 5 and 6, purely repetition, concept of adjusted present value. That is a very, very important concept where we'll be marrying the concept of investment decisions and financing. Adjusted present value is adjusted NPV. We'll be adjusting the net present value of a project to take into account financing side effects. Okay, so then determination of the firm's optimal capital structure, very, very interesting concept also. And then finally, long-term financing decisions, that is bond refinancing, lease by evaluation, rights issues, that one I'll not repeat. You know that you guys have gone through rights issues before in the lower level. So what you can see basically is that a number of issues here are purely repetitive. Now, when we talk about financing decision, just briefly before I pick on the third subtopic, that is what I'm going to pick on, breakpoints. Just briefly, financing decision are those one that deals with sourcing of finances. You guys are aware from your background of Section 3 that one of the financial decisions of a firm is making financing decisions. Just like you can make investment decisions, just like you can make dividend decisions, just like you can make liquidity decisions. Financing is about obtaining money to be able to finance an activity. Now, of course, from your background of Section 3, again, you're aware that companies raise money from various sources. When you talk about financing, generation of funds, they can come from internal sources, can come from external sources. Money can come from the medium term, from the short term, from the long term sources, and so forth and so on. Now, there is what we refer to as the firm's capital structure. I just want to give a brief summary before I pick on my main area of concentration. Capital structure is the mix of the various long-term capital. When a company goes for long-term capital through the issue of ordinary shares, through the issue of debentures, through the issue of preference shares, and even utilizing reserves, retained earnings available, that forms part of the capital structure. The firm's capital structure is the mix of the various long-term funds employed by a firm. A combination of equity, debenture capital, and the preference share capital. That is capital structure. But broadly, there is the financial structure, where capital structure is part of the firm's financial structure. Financial structure is the entire manner in which a company is financed, be they from the short term, be they from the medium term, or be they from the long-term sources. The entire manner in which a company is financed is what we call financial structure. So that means that capital structure is part of the firm's financial structure. It's broader. Financial structure is broader. Now, the prime objective of making a capital structure decision is to ensure that a firm adopts and maintain a capital structure which is optimal. Which is this optimal capital structure? It is that capital structure at which point the firm's value is maximized and the overall cost of capital is minimized. We'll be going through determination of the firm's optimal capital structure, and I think we'll be seeing some of those arguments. So there are a lot of stories which I've given you here, ladies and gentlemen. A lot of stories I've given you, and you can be reading on that. Now, the issue that I want to concentrate on today is analysis of breakpoints in the weighted marginal cost of capital. By the way, I should have also, remind you that the firm's overall cost of capital are of two forms. One is weighted average cost of capital. The other one is weighted marginal cost of capital. Both of them collectively are the firm's overall cost of capital. Weighted average cost is an average cost of existing funds. Average cost of existing funds. Weighted marginal cost is an average cost of raising additional funds. So when you want to establish the average cost of existing funds in the firm's capital structure, then that is weighted average cost of capital. And more often, weighted average cost of capital is determined more often than not by the use of market value weights. Weighted marginal cost of capital is an average cost of raising new or additional funds determined using book value weights. However, in a situation where the firm's capital structure is optimal, what sometimes we refer to as a target capital structure, then additional funds must be raised in proportion to the optimal proportions so as not to change or alter the optimal proportions in the firm's capital structure. What I want to say is that if the optimal equity proportion is 50%, then 50% of additional funds must come from equity. If additional proportion of debt, optimal proportion of debt is 30%, for example, then 30% of additional funds must come from debt. if the optimal proportion of preference share capital is 20%, then 20% of the additional funds should be raised from the issue of new preference shares. Why this is done is for the purpose of guarding against the change, for purposes of guarding against the change in the optimal proportions in the firm's capital structure. Optimal proportions are target proportions. Those proportions should not change. And the only way in which that can be maintained is for firms to raise additional capital in proportion to the optimal proportion, so as to maintain those optimal proportions. I'm not sure whether you guys saw that argument when you are going through weighted marginal cost of capital. When you listen to my video and look at the notes, did you guys see that argument? When you're given time to talk, it's a privilege for you to talk. You can unmute yourself and you can talk. Do you remember that argument? There's an argument I gave out under the weighted marginal cost of capital. If the capital structure of the firm is optimal, additional funds must be raised in proportion to optimal proportions to maintain those optimal proportions. Is that correct, Leah?
Yes.
Do you see that argument?
Yeah.
Caroline Kyoko, have you seen that argument?
No.
Have you seen that argument in my video for weighted marginal cost of capital? Elizabeth, have you seen my argument?
Yes, I've seen it.
Oh, Nancy, have you seen my argument?
Yes.
Now, you see, the only danger with this online teaching, I could be teaching students who are not KCA students. Yeah. Wengine wamepata link, wameingia class. Sasa hata tunaweza kwenda kufundisha wanafunzi sio wa KCA. That is the only very interesting thing, yeah? Ni kweli? Rosalind, kweli? Rosalind? Rosalind hataki kuongea? Ama is one of the victims? Rosalind, how are you? How are you, Rosalind? Ala, hataki kuongea kwa nini? Ridwan, how are you? Huyu Rosalind huyu nimemshuku sana, eh? How are you, Ridwan? Ridwan.
I'm fine. I'm fine, teacher.
Yeah. Okay, now that argument is very, very important. The fact that the capital structure is optimal, then caution must be taken not to change the optimal proportions. And I think I've emphasized in this document, when you're looking at my first paragraph, I've emphasized on that. Now, there is this thing we call breakpoints. What's a breakpoint? A breakpoint occurs if a firm were to move to an expensive source of funds, raise capital, having exhausted funds available from cheaper sources. If a firm were to move to a more expensive source of raising capital, having exhausted funds obtained from cheaper sources. That fact or that kind of a decision will lead to an increase in the weighted marginal cost of capital. If a firm were to shift from cheaper to expensive sources, then the effect of that is an increase in financing costs. If a firm were to exhaust the retained earnings available and decide to issue new ordinary shares, then the ordinary share capital is expensive equity compared to internal equity. That will cause an increase in the firm's overall cost of capital. If the firm were to exhaust funds available from the issue of a cheaper debenture, and then they decide to issue an expensive debenture, then that will cause an increase in the firm's overall cost of capital. If a firm were to issue a more expensive preference share, raise capital, having exhausted funds available from the issue of cheaper preference share, that will cause a breakpoint. So this shift from cheaper to expensive sources in raising additional capital will cause an increase in the weighted marginal cost of capital. That increase in the weighted marginal cost of capital is what we refer to as a breakpoint. Now, anytime an examiner is testing on breakpoints, ladies and gentlemen, we will see that kind of a shift. If it's an equity breakpoint, there will be a shift from retained earnings to issue of ordinary shares. Maybe, again, another shift to issue of other ordinary shares. You can have two equity breakpoints. If retained earnings are exhausted, the firm can issue ordinary shares. Then, if those funds are utilized the point of exhaustion, retained earnings and whatever the firm has raised through the issue of ordinary shares, a firm could issue other ordinary shares, causing another breakpoint. Issue of a 10% debenture, the funds have been exhausted, the firm can issue a 12% debenture, causing a breakpoint. They can issue 14% debenture, causing a breakpoint. And that can happen like that answer. So this shift from cheaper, more expensive capital of an element of the capital structure will cause a breakpoint. Now, let's not forget what I've begun by saying, that if the capital structure is optimal, then the raising of additional funds should not change the optimal proportions. At all times, firms must guard against the change in the optimal proportions. Now, one of the popular equity breakpoints is referred to as a retained earnings breakpoint. Retained earnings breakpoint is equal to retained earnings available divided by optimal equity proportion. This should give you something like X. I hope you guys are seeing my handout. Am I sharing the document?
Yeah.
Yeah, so retained earnings breakpoint is retained earnings available divided by optimal equity. Notice I'm talking about optimal equity. Optimal equity. Equity is both reserves and ordinary share capital. You'll find something like X. Now, what does this X tell us? X is the financing range up to which retained earnings represents equity. What we are saying is that if the total amount the company is thinking of raising lies between 0 and X, then retained earnings available represents equity. No need to issue ordinary shares. But if the total new funds are more than X, please let's understand this, because if we understand, we shall not spend a lot of time memorizing and will not struggle. Retained earnings breakpoint tells you the extent to which retained earnings available represents equity. Within that interval, like now, this is X. From shilling 0 to shillings X, that interval is sustained by retained earnings, no issue of ordinary shares. But if the total amount the company is thinking of raising is more than X, then having exhausted retained earnings, a company has to issue ordinary shares. Shillings X and above, retained earnings have been exhausted, and therefore the firm has to issue new ordinary shares. But of course, that additional equity must be in proportion to optimal proportions, so as not to change the optimal proportions in the firm's capital structure. Now, there is a dead breakpoint given by funds available from the issue of a cheaper debenture divided by optimal debt proportion. This is shillings Y. This can give us shillings Y. Same argument. The funds available from the issue of a cheap debenture, a cheaper debenture, represents long-term debt finance up to shillings Y. That means in the financing interval of shilling 0 to Y, from 0 to Y, the cheaper debt represents long-term debt. If the total new capital is more than Y, then having exhausted money available from the issue of a cheaper debenture, the firm could issue an expensive debenture, and that will cause a breakpoint. Same thing applies to preference share capital. We can have a preference share capital breakpoint. Funds available from the issue of a cheaper preference shares divided by optimal proportion preference share capital. In the financing interval 0 to Z, cheaper preference shares represents preference share capital. From shilling Z and above, the firm will have exhausted the funds available from the issue of cheaper preference shares, and for them to maintain the optimal proportion of preference share capital, then additional finance must come from the issue of other preference shares. If those additional preference shares issued are expensive, then that shall cause a breakpoint. The question I've shared here is a question from your past paper, May 2016, question 3. I don't know whether you guys can confirm this. Is it possible to confirm this? Is it a question from your past paper in May 2016?
It is.
Yeah, confirmed.
Now, can you take 5 minutes and read through the question? I've given you 5 minutes. Just read through and internalize on the question. And one of you, please read for us the question slowly. Let's interpret it slowly. One of you can read through the question.
On 1st January 2019, mavuno
Let's continue, madam. Continue, madam.
On 1st January 2016, Mavuno Limited was in the process of raising funds to undertake 4 investment projects. These projects require a total of 30 million shillings.
Just pause a bit. Just pause a bit. These projects require a total of 30 million. So what it means, if you look at it keenly, the issue of financing is going to come in. The company might want to raise additional finance of 30 million to undertake the projects. Continue, madam.
Given below are details relating to the 4 investment projects. Project A, B, C, D. Then we have required initial investment in millions. then internal rate of return in percentage.
Okay, usimama kidogo hapo. Now you see, capital budgeting. The question is on capital structure, but issues of capital budgeting are featured. Project A, there is B, there is C, there is D, there is initial cash outlay, and there is an internal rate of return. I've seen other questions where examiners can hide the internal rate of return. How much is can you confirm the total initial cash outlay? If you add for those 4 investments, how much is it? If you sum up, you can see that is 30 million. Eh? So the 30 million, which we are being informed up there, that will be raised. If you sum up those 4 investments, you can see you are finding 30 million. Continue, madam.
The company had 9 million shillings available for retained earnings at 1st January 2016. Any extra equity finance will have to be sourced through an issue of new ordinary shares. Now, just pause a bit. The company has 9 million shillings available from retained earnings. Now, don't worry about the dates. I've changed the dates because I wanted to make the question to be more relevant. The company had 9 million available from retained earnings as at 1st of January 2020. Any extra equity will have to be sourced through the issue of new ordinary shares. You see, one thing that you guys must know is that the retained earnings is cheap equity. What the examiner is simply telling you, if 9 million is exhausted, then from equity, the firm has to issue new shares. And because the issue of new shares is expensive compared to internal equity, then that will cause a breakpoint. So you can see quickly there is a breakpoint, which we are going to determine by taking retained earnings available divided by optimal equity proportion. If you take 9 million divided by optimal equity proportion, it should give you a breakpoint. Continue, madam. The market price of ordinary shares on 1st January 2016 was 25 shillings and 60 cents ex-dividends. Information on earning per share and dividend per share over the 6 years is as follows. We have year ended 31st December, EPS, the DPS from 2014 to 2019.
Now, one thing, just a minute again, just a minute. That price 25.6 is quoted ex-div. In a situation where the price is quoted cum-div, please be very, very careful. If the examiner quotes the price cum-div, cum means with the dividend, then identify dividend of the most recent year and remove it from the price. Anytime the examiner talks about cum-div, cum interest, you must get worried. But when he talks about ex-dividend, no problem. Now, secondly, look at the trend, earning per share and dividend per share. Clearly, you can see the earning per share are going up, dividend per share is going up. So we need to establish the growth rate in dividends. I think I went through those in class, a dividend growth rate. And of course, you can see now from that information, the computation of the cost of retained earnings and the cost of ordinary share capital, you can see the formula for establishing that. The dividend growth model. D naught is equal to D naught 1 plus G over KS. If you make KS the subject of the formula, then you can find the cost of retained earnings and you can find the cost of ordinary share capital using the growth model. Let's continue.
Issue of new ordinary shares would attract a flotation cost of 4.60 shillings per share.
Yes. Now, that's the difference between, that's what's going to cause the difference in the computation of the cost of retained earnings and the cost of ordinary share capital. So, of course, retained earnings don't attract flotation costs, but the issue of new ordinary shares attract flotation costs, and that cost will be deducted from the market price. Flotation costs are deducted from the market price. If you have looked at our video, I'm sure you have seen that reminder. Continue.
9% redeemable debentures of a par value of 1,000 shillings each will be sold with net proceeds of 95% due to a discount on issue of 2% and a flotation cost of 30 shillings per debenture. The maximum amount available for the issue of 9% redeemable debentures will be 4 million shillings.
Please listen to that
which-
sentence keenly. The maximum amount available from the issue of
The maximum
9%.
amount,
Repeat again that sentence because there's a breakpoint there.
the maximum amount available for the issue of 9% irredeemable debenture will be 4 million shillings, after which it would only be obtained at 12% interest with net proceeds of 90% of par value.
Now, you see another breakpoint there. If you look at the 9% debenture is cheaper compared to the 12% debenture, relatively. The 12% debenture is expensive. The examiner is telling you, if they exhaust 4 million available from the issue of a 9% debenture, then the firm will issue a 12% debenture, causing another breakpoint. So you guys are required to remember the formulas for finding the after-tax cost of a debenture, which is irredeemable. So far there are 2 breakpoints, which we can see. Continue.
10% preference shares can be issued at a par value of 80 shillings. The company's capital structure, which is considered optimal, is as follows. We have equity capital of 45%, preference share capital of 30%, and debenture capital of 25%.
Those proportions will help you in finding the breakpoint and also establishing weighted marginal cost of capital. So those are the target weights, the optimal proportions. Continue.
The corporate tax rate applicable is 30%. The company has to exhaust internally generated funds before raising extra funds from external sources.
Okay. Continue.
Required. The level of total new financing at which breaks occur in the weighted marginal cost of capital curve. The weighted marginal cost of capital for each of the 3 ranges of level of total financing as determined in A above.
Advise Mavuno on
Advise
projects to undertake.
Mavuno Limited on projects to undertake, assuming that projects are
divisible.
Then determine the optimal capital budget.
So this is, I think if my memory tells me right, this question was tested in section 3 sometimes back. So anybody who can confirm this? Do you remember the questions you did in section 3 by any chance? Could this be a question that was picked from section 3 and tested in section 5? Mkumbuke. Mnaweza kuwa mnakumbuka kweli? Mlizao.
No.
Levels of total new financing at which breaks occur. There are 2 breakpoints. One is retained earnings breakpoint. So you have captured these from additional information number 1. I think it was very clear that maximum retained earnings available is 9 million. When you come to additional information number 6, we know the equity proportion, 45%. So retained earnings breakpoint is retained earnings available over optimal equity proportion. 9 million divided by 0.45. Can you confirm that is 20 million? Retained earnings breakpoint. Is it 20 million?
Yes.
So that means
Yeah.
retained
20
earnings. Retained earnings represents equity in the interval 0 to 20 million. Eh? Remember, 20 million is the total. So from 0 to 20 million, that is the interval sustained by retained earnings. I think I've explained here. Financing range to be sustained by cheaper equity, that is 0 to 20 million. This means that expensive equity represents equity finance in the financing interval of 20 million and above. The other breakpoint is dead breakpoint. Guinea dead breakpoint. Funds from cheaper debt. Your cheaper debt is 9% debt. Mliona hiyo, eh? 9% debt, eh? Divided by optimal debt proportion. This is captured in additional information about. Number 4. The maximum amount available from the issue of a 9% debenture is 4 million. Optimal proportion of debenture, 30%, divided by 0.3. So 4 million divided by 0.25 or 0.3. I think there's an error. Is you ukiongeza zote ni 100 ama more than 100?
That's the venture capital is 0.25.
Hapa
That's
iko shida kidogo.
25%.
25%.
Yeah.
Na hiyo. Hii macho yote ijaona. Hiyo macho yote.
We are reading from the question paper.
Oh, hii yangu ndio iko na shida.
Hapo ndio iko na shida.
Is that 16 million? The dead proportion, the dead breakpoint, 16.
Yes, 16 million.
So again, that means from 0 to 16 million, the interval sustained by the cheaper debt, beyond which firm can issue an expensive debenture. You know, when you're told, you are not asked to explain. If you look at the question keenly, there's no explanation. It's only computing, eh? Sindio? Higher. Number 2, weighted marginal cost of capital for each of the 3 ranges of total financing determined in A above. Of course, there are 3 ranges. One breakpoint is 20 million. The other breakpoint is 16 million. So tutatoka 0 to, the first interval is 0 to the lowest breakpoint. Comparatively, kiangalia 20 na 16 ndio ndogo. So from 0 to 16 million, that is the first interval. The next one is from 16 million to 20 million. The other interval is from 20 million and above, but of course, to the maximum in which the company is considering raising. Nafikiri mnaona hivyo, eh? I hope you guys are seeing that.
Yes.
Jua nikiwa class naangalianga nyinyi kwa macho. Jua yule anaelewa na yule. Lakini sasa tuma. Mimi siwezi jua yule anaelewa na yule haelewi. Jua, eh? From 0 to 16 million, eh? Hiyo ndio the first interval.
Yes.
Then 16 to what's happened here?
20.
Ngine natoka 16 to 20 million. Then from 20 to the maximum, the farm is thinking of raising. Farm is thinking of raising how much? Ilikuwa 30.
Yes, it's 30.
Now, let me make an interpretation before I think it's good to understand what's happening here. The first 16 million. The company will raise the first 16 million. From 16 to 20, the farm will raise another 4 million. From 20 to 30, they'll raise 10 million. Yote itakuwa watakuwa wameraise ngapi? 16 plus
30.
4, 20 is 30.
30.
This farm will have
30.
raised 30 million shillings. Now, the first 16 million should be raised in proportion to the optimal proportions. The next 4 million should be raised in proportion to the optimal proportions. The last 10 million will be raised in proportion to the optimal proportion. There is so much that will come from equity, so much will come from the venture capital and preference share capital. 16 million is raised in proportion to the optimal proportions. What is the optimal equity proportion in that capital structure? Optimal equity proportion ilikuwa ngapi?
0.45
Times 16 million inakupatia ngapi?
7.2.
Tafadhali wacha tuache guesswork. 0.45 times 16. The optimal equity proportion is 45%. 45% of 16 ni ngapi?
7.2 million.
7.2 million.
Oh, is that retained earnings available? In the question, is that retained earnings available?
Yes.
Retained earnings ilikuwa 7.2 million.
9 million.
Sasa hii 7.2 natoka wapi? Okay, fine. What was the retained earnings breakpoint? Hiyo nimetoka kwa hiyo sheet. Retained earnings breakpoint ilikuwa ngapi?
20 million.
Oh, that is fine. That is fine. That is fine. We'll see what
20
happens.
million.
Aya. How much? I can see. I can see. The next is going to come in the next interval. That's okay. Okay. What was a debenture proportion that is optimal?
30%.
30% of 16 million in ngapi?
4.8.
2 point?
4.8.
Yeah. Should come from the issue of a debenture. Preferential capital proportion, which is optimal?
4.8 ni ya nini? Preference.
Excuse me, sir.
Yes.
The debenture optimal structure is 25%.
Okay. 25% of 16 million?
It's 4.
Is 4.
4 million. Preferential capital proportion, which is optimal?
4.8.
That is 4.8 million. Will this farm, will it have raised 16 million?
Yes.
Yeah. The next interval, here is 16 to 20, that is 4 million. How much of that will come from equity? Again, using the same proportions, 4 million shillings. Equity, 30%? Ile proportion of equity that is optimal?
1.8 million.
1.8. 1.8 million.
1.8 million.
Debenture capital? How much will come from?
1 million.
1 million. Preferential capital?
1.2 million.
Will they have raised their 4 million shillings?
Yes.
Yeah. Final range, 20 to 30 million. How much will come from equity, debenture, the preferential capital?
$4.5 from equity.
4.5 for
4.5 million equity. Debenture?
2.5.
5.
Huh?
And 3.
Debenture?
2.5.
2.5.
2.5. Issue of preference shares?
3.
3 million.
3 million. Will they have raised their 10 million shillings? The company will have raised 10 million, isn't it? 4.5 plus 2.5 is 7 plus 3. Now, hebu tuangalie kinly, eh? Hebu kidogo tuangalie kinly tafadhali, eh? Yule amelala kidogo, amuke sasa, eh? Tuangalie kinly something here. What was the retained earnings breakpoint?
$9 million.
9 million, eh?
20 million.
Oh, sorry,
Nine
sorry.
number.
It was 20.
20 million.
20.
breakpoint.
So that means retained earnings represents equity in the interval 0 to 20. Eh? Tumesema namna hiyo. Okay. In the interval 0 to 16 and 16 to 20, from 0 to 20, that's the interval where retained earnings represents what? Represents equity. That means the 2 million is retained earnings. The 1.8 million is also retained earnings. Retained earnings breakpoint is 20 million. In the interval 0 to 20 million, retained earnings represents equity. So that means that in the first interval, this amount from equity will come from retained earnings. 1.8 will come from retained earnings. The total is how much?
9 million.
9 million. And what did the question tell you? How much is the maximum amount to be raised from internal sources?
9 million.
9 million.
Does that confirm that?
Yeah.
Yeah, the 7 million, 7.2 and 1 point, we have exhausted retained earnings. So these 4.5 should come from the issue of new ordinary shares. Eh? Sindio? Having exhausted the 9 million, 7.2 and 1.8, the 4.5 should come from the issue of new ordinary shares.
No.
Are you seeing that? Are you guys seeing that? I hope you are seeing that. Eh? When I said retained earnings breakpoint is 20 million, I said from 0 to 20 million is the interval sustained by retained earnings available. And you can confirm 7.2 and 1.8. Dead breakpoint ilikuwa ngapi? The dead breakpoint?
16 million.
16 million. So that means the 4 million will come from the issue of the cheapest debt. Let me call it KD1, the after-tax cost of the cheaper debt, 9% debenture. Then beyond there, the firm will issue a 12% debenture, this one, KD2, and again, KD2, 12% debenture. How much was the maximum amount available from the issue of a 9% debenture? Was it 4 million? The issue of a 9% debenture, the maximum amount available in ngapi?
4 million.
4 million.
Naona kwa hiyo swali hiyo ni 4 million. Exhausted, eh? So in the next interval, 1 million and the 2.5 million will come from the issue of a 12% debenture. Then, of course, preference shares, there is no breakpoint. Hii ya kwanza ilikuwa ngapi? 4.8 and 1.2 and 3 will come from the issue of preference shares. Eh? The same preference shares. Preference shares haina breakpoint, si ndio? Sio mliona namna hiyo? So you see, in the first interval, 0.16, the overall cost of capital will be cost of retained earnings times optimal equity proportion, the cost of the 9% debenture times optimal debt proportion, the cost of preference share capital times optimal preference share capital proportion. You will find the overall cost of capital here. Kiangalia mzuri, weighted marginal cost of capital itakuwa cost of retained earnings times optimal equity proportion a KDT1WD plus KPWP in the first interval. The overall cost of capital, the cost of retained earnings, optimal equity proportion, the after-tax cost of the cheapest debt times optimal debt proportion, cost of preference share capital times optimal. When you come to the next interval, let me call it 2, still equity is represented by retained earnings, cost of retained earnings times optimal equity proportion. Now here, KDT2 times weight of debt, KP times that. So in the next interval, still 1.8 is from retained earnings times optimal equity proportion, the after-tax cost of the 12% debenture times optimal debt proportion, cost of preference share capital times that. When you go to the last interval, weighted marginal cost of capital in the last interval now is cost of ordinary share capital times optimal equity proportion, KDT2 times weight of debt, KP times weight of P. Equation 2. I've gone a very long way to do that interpretation. So what we need to look for is cost of retained earnings, the cost of the ordinary share capital, the after-tax cost of the cheapest debenture, after-tax cost of expensive debenture, and the cost of preference share capital. You have to do the working for these elements. Cost of retained earnings, cost of ordinary share capital, the after-tax cost of the 9% irredeemable debenture capital, the after-tax cost of the 12% irredeemable debenture capital, and the cost of preference share capital. Shapata hiyo, mnaingia hapo, hiyo swali inafanyika, si ndio? I hope the interpretation is making sense, eh? Naona watu wanaendelea kutoroka, sijui kama ni bundles zimeisha. Bundles zimeleta shida, eh? Bundles zimeleta shida ama namna gani? So the next question we are required to answer, weighted marginal cost of capital in each of the 3 ranges of total financing. That's what I've been interpreting. But instead of going through that long route, you can see the shortcut I've taken. Financing range 0 to 16, 16 to 20, 20 and above. Unaona hapo, eh? Je, mnaona? Then there is equity, debt, preference share capital, the firm's weighted marginal cost of capital. Cost of retained earnings, hiyo ndio formula inatumika. Cost of retained earnings, because you saw dividends are growing, so D naught 1 plus G divided by P naught plus G. Dividend growth rate, I think I did a working somewhere here. Inakuwa 7%. Hiyo najua, you guys don't have an issue getting the dividend growth rate. So the most recent dividend in the historical data is 3.5. Angalia, the most recent dividend in the year 2019 is 3.5. Of course, which will grow at 7%. Your growth rate metafutwa divided by 25.6 plus 0.07 times 100. The cost of retained earnings 21.63. Is that correct? Can you go to your calculator and confirm? We want the answer confirmed.
Yes, it's correct.
Okay. Now the next is cost of ordinary share capital. We use the same formula. We use the same formula except we bring in flotation cost and deduct from the share price. So dividend is still 3.5, 1 plus 7% over 25.6, remove flotation costs. We are given flotation costs in the question. Flotation cost to deduct from the share price of 4.6, growth rate 7%. Could you again confirm that that is correct? For me. Angela? For me. Can you confirm the cost of ordinary share capital, whether it is correct again? For me, Angela, can you ask for me to come?
It's correct.
Correct.
Yes.
Picha, tumia kwa WhatsApp. Piga mzuri, tumia kwa WhatsApp. Okay. The after-tax cost of the 9% redeemable debt. Now, this debenture is redeemable, so the after-tax cost is interest in bracket 1 minus T divided by market value of debenture minus flotation cost minus discount cost times 100. The coupon rate of the debenture, we were told, is 9% times par value of 1,000. That is interest, bracket 1 minus tax rate divided by 1,000 minus discount cost minus flotation cost. I think we were informed in the question. Additional information number 4, somewhere there. Discount cost 2%, flotation cost 30. So discount cost is 2% of 1,000, which is 20. Flotation cost is 30. You remove discount cost and flotation cost from the price. Does it give us 6.63%? Could you please confirm the answer quickly? Does it come to 6.63%? The after-tax cost of 9% redeemable debenture.
It's correct.
Is the answer correct? Hiyo 9% redeemable debenture, do you find?
Yeah, it's correct.
Okay. 12% redeemable debenture, is it also correct?
Yes.
You know, there was a trick. The coupon rate is 12%, par value is 1,000, 1 minus 0.3. Then you are informed in that additional information, ukiangalia mzuri, you are informed. Hebu ukiangalia additional information huko mwisho, after which debt could be obtained at 12% interest with net proceeds of 90% of the par value. Net proceeds. So 90% of the, they were not told which par value, but we have assumed 1,000. We have assumed par value of 1,000. So 90% of 1,000. Do you find 9.3%? We have assumed that par value is assumed par value. Okay. It's an assumed par value. Angalia mzuri kwa swali, uchapewa the par value of a 12% debenture, it is assumed to be 1,000, just like the existing one, the cheaper debenture. Now, cost of preference share capital, 10% times par value divided by market value, that is 10. Then, of course, if you check now the schedule, from 0 to 16, retained earnings. From 16 to 20, retained earnings. That's why I've repeated. Now, you need to be very careful with that schedule. Please be careful with that schedule. Retained earnings breakpoint is 0 to 20 million. So the first interval, you pick the cost of retained earnings. Next interval, the cost of retained earnings. The final interval, cost of ordinary share capital. I hope you guys are seeing that. I hope you are seeing that. Are you seeing that? I hope we are seeing that. Retained earnings breakpoint is 20 million. So from 0 to 20 million, consider the cost of retained earnings. 20 million and above, the cost of ordinary share capital. Then the cheaper debenture. Breakpoint was 16 million, 0 to 16. We pick 6.63. Then the other intervals, the other debenture. Then cost of preference share capital, that one, no difference. So if you multiply now, you take 21.63 times 0.45 plus 6.63 times 0.25 plus 10 times 0.3. Does that give you 14.4? The weighted marginal cost of capital? in the range 0 to 16 million.
Yeah.
Huh? The first interval, do you find 14.4?
Yes.
Okay, 16 to 20 million, the same weight times those component items times the weights. Does it give you 15.1%? The target weights.
Yeah. Yeah. Yeah.
And the final interval, 20 million and above, does it give you 16.5%?
Yeah.
Does it confirm that?
Yeah. 16.5.
Okay. So are we seeing the breakpoints? 14.4. Then the nominal cost of capital went up to 15.1. It went up to 16.5. That is the breakpoint. You can see the breakpoints. Eh? So we have answered number B, weighted marginal cost of capital for each of the three ranges of total financing determined in ABAP. Anything that is not clear to that extent? Anything that is not making sense to that extent? Are we together?
Yes.
Are we together so far up to that extent? Higher, number 3, advise Mavuno on the project undertaken, assuming that these are divisible. Now, sometimes this one I've not answered in this schedule. This is what I was answering there using the investment opportunity schedule. I want you to refer to your, I've sent a solution for that to your WhatsApp. I was unable to make a sketch of that. Sijafanya sketch hiyo, lakini mkiangalia kwa WhatsApp mtaona. Just go to your WhatsApp group. Are you seeing in your WhatsApp group? Solution is there in your WhatsApp group. Are you seeing it there?
Yes, it has been sent.
Now, what you do, this schedule, the investment opportunity schedule, is a diagrammatic representation drawn by plotting internal rate of return and weighted marginal cost of capital against cumulative funds. You plot IRR, WMCC along the y-axis against cumulative funds. Against cumulative funds. You remember these projects required a total of 30 million shillings? These investments require a total of 30 million shillings. Sasa mkiangalia on the y-x-axis are moved up to 30 million. 0, 2 million, 4 million, nimeenda hivyo mpaka 30 million. Unaona namna hiyo? Yeah, the maximum those projects require is 30 million. Now, then you need to have a scale on the y-axis that accommodate internal rate of return and weighted marginal cost of capital. If you look at this internal rate of returns, on 16, 20, 22, 26. The weighted marginal cost of capitals we have worked out 14.4, 15.1, 16.5. Now, you need to have a scale that accommodates all that. So, mkiangalia kwa hiyo diagram, I began with plotting IRR against cumulative funds. Of course, starting with the project with the highest actual return. the investment with the highest actual return, ndio unaanza nayo. Hiyo ni project A. Ukiangalia hiyo project A requires for 8 million shillings. If you check along the x-axis, I moved up to 8 million shillings. Huko juu, actual return 26%. So if you look at that schedule, A requires 8 million, the initial cash outlay, actual return is 26. Then in the pecking order, you come to project D. D, the actual return is 22, requiring 18 million. So 8 plus 6, 14. You move up 14. From 8 million to 14, that is 6 million. Actual return 22%. Ukiangalia kwa hiyo graph utaiona. Then from there you move to project C, 9 million. So cumulatively, 14 plus 9, you go up to 23, the actual return of 20. Then from there, 23 plus 7, the final investment, you go up to 30 million, the actual return. So you need to be very, very careful in that order. Then from there, you introduce the weighted marginal cost of capital schedules, the ones which we have worked out here. You see from 0 to 16, 14.4. You go to a graph and check 14.4 in the financing interval 0 to 16. Hapa ukiangalia kwa hiyo graph, I've moved from 0 to 16. 14.4, alafu inapanda juu kidogo, 15.1 in the interval 16 to 20 million, alafu inapanda kidogo to 16.5 in the interval 20 million and above. Now you can see that diagram. I think you can slot it into your notes. And clearly, you can see that investment A, D, and C are acceptable. Well, using the rule, the capital budgeting rule, investment A, D, and C are acceptable because the actual return are more than cost of capital. But investment B should be rejected because cost of capital is more than the actual return. And therefore, the optimal capital budget in this case, the optimal capital budget in this case is how much the firm needs to undertake the 3 investments which are acceptable. In this case, A, D, and C. Those 3 investments need a total of 23 million. And therefore, that 23 million is what we refer to as the optimal capital budget. I think that winds up that issue. I want to believe that the concept is making sense. Just look at your past paper. There are other questions you can be attempting.